Welcome to the IMFG Quarterly Market Update. My name is Scott Douglas. I'm a director with IMFG. And today I have here Dr. Steve Garth, who's the head of our investment committee, to talk about what's been going on in the last quarter. So, Steve, what's actually happened in the last quarter and what have been the key themes that have come out of that?
Yeah, thanks, Scott. Well, in fact, the key themes are Trump, tariffs, and trade wars, and it's really created quite a tumultuous quarter. So the tariffs have just been announced yesterday, but they've been around for the whole quarter and has created a great deal of uncertainty in the market, particularly in the US. So if we start there, Scott, normally we would show the return of the S&P 500, which is the main representation of the American market. But here I'll split it into the two separate parts that make up the S&P 500. One is the NASDAQ. That's where all the big tech stocks are listed: Apple, Google, Nvidia. And the other one is the New York Stock Exchange, and that's where the older industrial companies are listed. And you can really see a tale of two different exchanges here. The NYSE, done okay, it's actually up 2% for the quarter, but nothing to really write home about. On the other hand, you can see that the NASDAQ, it's really been hit by this uncertainty around tariffs more than the New York Stock Exchange stocks. It's down by 10%. That's what they call a correction.
So, Steve, why have the tech stocks been hit harder than the rest of the general market? Like, what's been driving that?
That's a good question, Scott. There are really two reasons. Number one is tech stocks are more sensitive to inflation. And as we mentioned, the tariffs are potentially inflationary. And so the tech stocks don't like higher interest rates and don't like higher inflation. But there's another big reason. The biggest company on the US Stock Exchange, the biggest company in the world really, is this stock called Nvidia, which a few years ago no one would have heard about. It returned 179% last year. It makes chips for artificial intelligence uses, and it has come off 20% in the quarter. Now, some of this is just due to the market, but the other thing is in February, the Chinese released a startup called DeepSeek, which was a faster, cheaper, and more efficient AI chip.
Yeah.
And the market suddenly said, oh, maybe we've been overvaluing NVIDIA. AI is still here to stay, but it doesn't mean NVIDIA is going to, or the US in fact, are going to be the leaders in the AI space. There's clearly competitors there. So the big fall in NVIDIA, which has really brought down the NASDAQ, which has then brought down the US, has really come down to this competition out there, and we need to rethink what our valuations for NVIDIA are.
Right, so yeah, we've had like one stock that's been the focus around the world that has a big contribution to world markets as well. So what about like when we look at the rest of the world, where are we seeing what's been going on in Europe and those places?
Yeah, so Scott, first of all, the way we look at the world is really through the lens of a world index, the MSCI World Index. And that is made up of 70% of the US. So, like they say, when the US sneezes, the rest of the world catches a cold.
Yeah.
If the US is going to have a bad quarter, guess what? The rest of the world is going to feel that a little bit too. So the MSCI World Index down 3%, mainly due to the fact the US is down. But another big part of that market, as you mentioned, is Europe. They're up by 10%. And the emerging markets are up over 2% as well. You will see Australia there is negative. Australia is a very small part of that world index, so it's like 2 or 3%, so it doesn't really move the needle. The biggest contributor to the rest of the world is the US.
Right, okay. So what with Australia, where are we standing and what's been happening in our market, which is a big part of people's portfolios?
Yeah, absolutely. So obviously uncertainty around tariffs have played into the returns of the quarter. You can see the market's down by 2.8%. Now, in fact, tariffs are going to have very little effect on the market overall. So general global uncertainty has been at play. But the big reason why the Australian market is down, which by the way, it was hitting peaks in February, and that was at the time that the RBA actually had a 25 basis point cut. And you'd think, well, market was going to love this, cutting interest rates, we're hitting the peak, it's going to be happy days ahead. But the RBA said very clearly that the cut was there because the economy is slowing and they need to get the economy growing a bit faster. In fact, our economy is sort of the slowest growth it's been in quite a while.
I know it's hard to predict, but where do you think we're going
So
to end up?
it's a very good question.
rates?
So, of course, the RBA met just 2 days ago before we're recording this and left rates on hold. And 2 weeks earlier, the Federal Reserve in the US left their rates on hold. Central banks are a bit caught at the moment, all talking about tariffs, which has been the dominant theme of the quarter and, of course, in overnight.
Yeah.
It's all about tariffs. Tariffs are inflationary. It's going to cost more to buy goods, particularly for the US. That's why the US is hardest hit. If inflation's going up, central banks need to raise rates, and that's what we saw a few years ago. But the economies are slowing. Tariffs are also slowing global growth. When economies are slowing, central banks need to cut rates. So they're stuck at the moment, Scott, between expectations of inflation, where you should be raising rates, but trying to get the economy moving by lowering rates. So it's not clear which way they're going to move. Most likely they're going to move downward, but we're not sure when that will happen.
Well, thank you, Steve. That was excellent insights, and we're in a very interesting time at the moment. The important thing is to stick to your plan, talk to your advisor, and stay focused on the longer term outcomes. We appreciate everything, and thanks for attending.